413 million euros. That was Porsche's operating profit for 2025, a company that just 12 months earlier had posted 5.64 billion euros, 92.7% gone in a single year. This isn't some struggling mid-tier automaker fighting for survival against Chinese competition. This is Porsche, the brand that turned sports cars and luxury SUVs into a printing press for Volkswagen Group, the company whose CEO stood on stage in 2021 and declared the battery cell is the combustion chamber of the future, with the kind of confidence reserved for people who genuinely believe they've seen what's coming next. Oliver Blume didn't hedge that statement. He staked Porsche's entire identity on it, the same way the brand had staked its soul on flat-six engines for 70 years. That future he promised never arrived, or more accurately, it arrived in all the wrong places, at all the wrong speeds, and now Porsche is standing in the wreckage of that bet, trying to explain how the most profitable car company on earth lost 92% of its profit in 12 months. This wasn't one bad call. This was 5 simultaneous miscalculations, all colliding at once, and every single one of them connects back to that battery cell promise. Now let's talk about what actually happened when reality caught up to that vision, because these numbers are almost surreal for a brand this prestigious. Porsche's operating profit for 2025 came in at 413 million euros, down from 5.64 billion the year before. But the automotive division specifically, the part of Porsche that actually builds and sells cars, tells an even darker story. Automotive operating profit collapsed 98.3% from 5.3 billion euros down to just 90 million euros. Porsche's automotive margin, the metric that measures how much profit the company extracts from every vehicle sold, disintegrated from 14.5% down to 0.3%. For context, a healthy luxury automaker typically operates in double-digit margin territory. Porsche's margin essentially became a rounding error. 2 catastrophic one-time charges nearly obliterated the entire year. A 3.9 billion euro write-down tied to reversing its EV strategy, plus restructuring costs from a company that suddenly had to unwind years of electric-first planning it had committed billions toward. Add a persistent sales collapse in China and roughly 700 million euros in costs from U.S. import tariffs, and you get a bottom line that simply evaporated. Here's what makes this genuinely alarming. This wasn't a single surprise announcement. Porsche issued 4 separate profit warnings throughout 2025. 4 distinct moments where the company had to return to investors and admit actually, it's worse than we told you last time. By the time the damage was fully visible, Porsche's stock had shed more than 30% of its value, and the company got kicked out of Germany's DAX index, the list of the country's top 40 publicly traded companies. Shares eventually settled roughly 50% below their IPO peak. A company that debuted at a 75 billion euro valuation, celebrated as one of the largest European IPOs in years, had lost approximately half its value in about 3 years. New CEO Michael Leiters, who took over at the start of 2026, didn't attempt to sugarcoat any of it. He said Porsche would comprehensively reposition the company to make it leaner, faster, with products that are even more desirable. Translation: what Porsche had been doing for the past 4 years fundamentally wasn't working, and everyone at the executive level finally admitted it out loud. With profits gutted and the EV bet clearly failing to pay off, Porsche moved into full damage control mode, and the cuts have been absolutely brutal. Porsche already had 3,900 planned job cuts through 2030, with roughly 2,000 temporary positions eliminated. Then in mid-2025, the company added another 1,900 permanent layoffs on top of that. Porsche employs around 40,000 people total, which means more than 10% of the entire global workforce is being eliminated. CFO Lutz Meschke said a second round of cost-cutting measures focused on salary levels and employee perks, rather than pure headcount reductions, was already being negotiated with labor representatives, and he warned that large-scale solutions were needed. Then in May 2026, Porsche went even further, shutting down 3 subsidiaries entirely and cutting over 500 more jobs. The highest profile casualty was Cellforce Group, the very battery subsidiary Oliver Blume had championed back in 2021 when he called the battery cell the combustion chamber of the future. Cellforce was supposed to give Porsche its own in-house high-performance battery technology, a genuine engineering edge over competitors who bought their cells from outside suppliers like CATL and LG. Instead, Porsche had already scaled Cellforce back once in August 2025, cutting roughly 200 of its nearly 300 employees and converting it into a research-only unit. By May 2026, even that scaled-back version wasn't viable. The remaining 50 employees lost their jobs, and Cellforce was shut down completely. Porsche's own executive board member for research and development, Michael Steiner, said plainly, that due to a lack of volume worldwide, it just wasn't possible to scale up in-house production to the planned cost position. Porsche will now lean even more heavily on outside suppliers like CATL for its EV batteries, the exact dependency the company had originally tried to escape by launching Cellforce in the first place. Porsche e-bike performance and a software subsidiary called MHP were shut down in the same announcement, and just weeks before that, Porsche sold off its stake in Rimac and Bugatti Rimac entirely, walking away from performance EV and hypercar ventures it had spent years building relationships around. CEO Michael Leiters summed up the philosophy behind all of it in one sentence: Porsche must refocus on our core business. To understand how catastrophic this collapse actually is, you need to understand how high Porsche was flying before gravity caught up. For years, Porsche wasn't just Volkswagen's flashiest brand, it was Volkswagen's entire profit engine. While Volkswagen itself struggled with razor-thin margins on Golfs and Passats, and Audi fought to stay relevant against BMW and Mercedes, Porsche quietly printed money, with the kind of markup most automakers only fantasize about during product planning meetings. Sports cars with 60% margins, SUVs selling above sticker price, a brand so strong that customers waited months just for the privilege of paying premium rates. In 2024, Porsche's operating profit hit 5.64 billion euros. Its automotive division alone posted a 14.5% margin, a number that would make Toyota executives weep with envy and make Mercedes question their entire pricing strategy. Porsche wasn't just a car company nested inside a bigger car company, it was the reason Volkswagen Group's consolidated numbers looked remotely acceptable to investors. Strip out Porsche's contributions, and Volkswagen's financials started looking uncomfortably similar to companies heading toward restructuring, and Porsche's leadership knew exactly where they thought the future was headed. In 2019, the Taycan launched as Porsche's first all-electric vehicle, and it genuinely was an engineering achievement, a car that could sprint to 60 miles per hour faster than most supercars while maintaining the driving dynamics Porsche owners expected. Oliver Blume didn't just believe in electrification, he became one of the loudest evangelists in the entire automotive industry. In 2021, when Porsche announced its own battery cell venture called Cellforce, Blume delivered that line about the combustion chamber of the future, and he meant every word. That wasn't a throwaway soundbite crafted by a communications team. That was Porsche fundamentally redefining its identity around electric power. The plan was breathtakingly aggressive. 80% of new car sales fully electric by 2030, a brand new EV-only platform in development for the next decade. The Macan transitioning to pure electric, the 718 Boxster and Cayman, those entry-level sports cars that had introduced an entire generation to the brand, getting electric successors, even the Cayenne, Porsche's biggest volume seller responsible for keeping the lights on during lean years, was getting an EV variant. For a moment, the vision looked almost plausible. The Taycan sold respectably in its first years. China, historically Porsche's single largest market, was exploding into the biggest EV market on the planet, and Porsche wanted its share. Wall Street adored the narrative. When Porsche went public in a blockbuster 2022 IPO valued at roughly 75 billion euros, investors weren't just buying a sports car manufacturer. They were buying the story that Porsche could deliver Ferrari's profitability with Tesla's growth trajectory rolled into one publicly traded stock. That was the pitch. That was what convinced institutional investors to pour billions into the offering. If you want to pinpoint the exact moment Porsche's crisis stopped being deniable and started becoming undeniable public fact, it's the third quarter of 2025. Porsche reported a 966 million euro operating loss for Q3 2025, not a reduced profit, an actual loss worth roughly $1.1 billion. A year earlier, that same quarter had delivered a 974 million euro profit. That's not a downturn. That's a complete reversal from profit to loss in 12 months, and it landed significantly worse than analysts had even feared. Wall Street was bracing for a 611 million euro loss. Porsche delivered nearly double that figure. What went wrong all at once? Start with China. For over a decade, China was Porsche's golden goose, the single market where wealthy buyers lined up for 911s, Cayennes and Panameras at premium prices without hesitation. That era is definitively over. Chief Financial Officer Lutz Meschke told investors with unusual bluntness that Porsche expects China sales to keep declining into 2026, saying, quote, "We have to assume that the general market conditions will not improve in the foreseeable future." That's about as direct as a CFO gets on an earnings call when discussing a core market. In the first quarter of 2026 alone, Porsche's deliveries in China dropped 21%. Then layer on the tariffs, The United States is Porsche's biggest market, and because Porsche imports every single vehicle it sells in America rather than manufacturing locally, the 15% import tariffs imposed by the Trump administration hit the company with brutal force. That tariff exposure cost Porsche roughly 700 million euros in 2025 alone. North American sales in early 2026 fell 11% as sticker prices climbed to offset those costs. When you're selling a $150,000 sports car, tariffs aren't a minor inconvenience, they're a direct hit to demand. Then there's Europe, where sales fell 18% in the same period. The one marginal bright spot was Germany itself, which actually saw a modest increase, but losing ground simultaneously in China, North America, and the broader European market is about as catastrophic as it gets for a global luxury brand. Porsche did maintain its full-year 2025 guidance, forecasting a return on sales of up to just 2%, down from 14% the year before, and the company had to propose a significantly lower dividend for shareholders than the 2.31 euros per preferred share it distributed for 2024. Management insisted 2025 would be the trough, the absolute low point before recovery begins. But when your own executives are using words like trough to describe your flagship year, that tells you everything about how severely things deteriorated. Here's where the story takes its most dramatic turn. Faced with collapsing profits and a market that clearly wasn't ready for Porsche's electric-first vision, the company did something almost unthinkable for a brand that had staked its entire identity on EVs just a few years earlier. It reversed course completely. Porsche announced it would delay the launch of several planned electric models, including electric versions of the 718 Boxster and Cayman, the sports cars that had introduced generations of drivers to the brand. Current models like the Panamera and Cayenne will continue to be offered with combustion engines and plug-in hybrids for the foreseeable future, extending well into the 2030s. That's not a minor adjustment to the product roadmap. That's Porsche openly admitting the pure EV timeline it promised investors just a few years ago isn't happening anymore. Even more revealing, Porsche scrapped its planned new EV-only platform for the 2030s in its original form. Instead, the company is redesigning it in coordination with other Volkswagen Group brands to allow greater flexibility across drivetrains, meaning it needs the option to keep building gas and hybrid vehicles on the same architecture, not just electric ones. Porsche also walked away from a joint vehicle development project with Volkswagen Group that had been built around that same all-electric assumption. The ripple effects hit the entire Volkswagen Group hard. Volkswagen said it now expects a nearly $6 billion hit to its own operating profit for 2025 directly because of Porsche's EV delays and platform write-downs. Porsche also quietly reduced its own medium-term profit targets for the Volkswagen Group, cutting the expected return on sales from a projected 15 to 17% down to a more conservative 10 to 15%. When your subsidiary's failed strategy is dragging down the profit forecast of the entire parent company, that's not a Porsche problem anymore. That's a Volkswagen Group crisis, and the timing could not have been more brutal. Porsche's flagship EV, the Taycan, saw deliveries fall 22% in 2025, dropping to just 16,339 units worldwide. Meanwhile, the gas-powered 911, the car Porsche has built its reputation on since 1963, quietly set a delivery record with 51,583 units sold in 2025. Let that comparison sit for a moment. The car Porsche built the electric future around was outsold more than 3-1 by the combustion engine sports car it's had in the lineup for over 60 years. Here's where Porsche's crisis stops being about spreadsheets and starts hitting actual customers in actual showrooms. The Macan is one of Porsche's best-selling vehicles, a compact SUV that's been a gateway car for an entire generation of buyers who couldn't quite justify a 911 but wanted the badge and the driving dynamics. Porsche discontinued the gas-powered Macan this past summer, planning to fully replace it with the electric Macan. Problem is, demand for the electric Macan has badly lagged behind the combustion version it replaced, especially in the United States, where the $7,500 federal EV tax credit phases out for vehicles above a certain price, and the electric Macan's pricing puts it right out of reach of that incentive. Buyers weighing a $70,000-plus electric crossover against comparably equipped gas competitors are making a simple value calculation. And right now, the math doesn't favor Porsche. So Porsche now needs to bring back a combustion or plug-in hybrid version of the Macan, except that replacement isn't expected to arrive until 2028. That leaves a multi-year gap where customers who want a traditional gas or hybrid Macan simply have nowhere to go inside the Porsche lineup. They either wait years or they walk into a Mercedes, BMW, or Audi showroom instead For a brand built on making customers feel like Porsche always has exactly what they want, that gap is close to unthinkable. And then, there's China, the market Porsche once treated as its golden goose. For over a decade, Chinese buyers helped fuel record profits, snapping up Cayennes, Panameras, and 911s at premium markups few other markets could match. That era is gone. Deliveries in China dropped 21% in the first quarter of 2026 alone, part of a longer, painful slide. Porsche has largely pointed to slower EV adoption as the culprit. But here's the uncomfortable truth underneath that explanation. China is now a market where electric vehicles make up more than half of all new car sales. If EV hesitancy were really the whole story, Porsche should be thriving there with the Taycan and electric Macan. Instead, it's losing ground across the board, gas models included. The real problem looks less like Chinese buyers rejecting EVs and more like domestic Chinese brands out-executing Porsche on both technology and price, in a market where local competitors like BYD, NIO, and Xiaomi are moving faster and pricing far more aggressively than a German legacy automaker ever could. That's the trap Porsche finds itself in. It bet on electric to win China and lost ground anyway. It's now scrambling to rebuild the combustion lineup it thought it would never need again, and it's trying to do all of that while cutting over 10% of its global workforce and writing down billions of euros in sunk EV investment. 3 different fires burning at the exact same time. So let's go back to where we started. The battery cell is the combustion chamber of the future. Oliver Bloom said that in 2021 with absolute conviction, and honestly at the time it wasn't a ridiculous thing to believe. EV sales were climbing fast. China was electrifying quicker than anyone predicted. Tesla's stock was defying every conventional valuation metric. Every legacy automaker on Earth was terrified of being the next Kodak, the next Blockbuster, the company that missed the technological shift standing right in front of them. Porsche didn't want to be that company, so it bet everything. Its platforms, its battery technology, its entry-level sports cars, its best-selling SUV, on electric power arriving faster than it actually did. But here's the uncomfortable truth underneath this entire story. Porsche's crisis was never really about whether electric vehicles are good or bad. The Taycan is by most accounts a genuinely excellent car. The problem was timing, scale, and geography all colliding at once. Porsche bet on a global EV transition that moved slower in the US and Europe than projected, while in China, the one place EVs actually did take off as fast as predicted. Porsche still lost ground because domestic competitors simply built better. Cheaper electric cars, faster than a 100-year-old European brand could respond. Layer on tariffs nobody fully priced in, and a battery venture that never hit the volume it needed to be cost competitive, and you get a company where almost 6 billion euros in profit disappeared in a single year. Not because of one bad decision, but because 5 different bets all soured at the exact same time. This doesn't mean Porsche disappears. It's still building some of the most desirable performance cars on the planet. The 911 just set a delivery record. The brand still commands loyalty and margins most automakers would kill for. But the version of Porsche that confidently declared the battery cell was the combustion chamber of the future. That Porsche is gone. What's replaced it is a company that got humbled by its own ambition and is now racing to rebuild the combustion lineup it was so sure it wouldn't need. And that right there is the real story behind the Porsche disaster nobody saw coming. Not a single catastrophic failure, but 5 simultaneous miscalculations. A battery bet that never reached scale, an EV timeline that outran actual demand, a China market that shifted faster than Porsche could follow, tariffs nobody fully planned for, and a product gap that's about to leave loyal customers with nowhere to turn until 2028. If this story proves anything, it's that even the most profitable, most beloved brand in the car world isn't immune to betting big on the future and getting the timing wrong.